I've started recording. Thank you. It's okay. It's okay. Now, it's okay, Pauline. Now, financial risk management. From the word finance, that is about money and investment. And risk, that whenever you are investing, there are always risks. So how do you manage the risk that can affect your financial investments or your investment in general? That is topic number 6. This area needs to cover a few areas that you need to understand. We're going to use the word derivatives. You see, the money is normally attached on some objects. In the olden days, we'll attach them on gold and such like things, or silver, right? We also had situations where we would even trade goods and goods. But today, we are having money in terms of paper. We call them treasury bills. We call them bonds and such like things, or commodities. So when you talk about commodities, these are petrol, like oils or petroleum products. And then we can have the treasury bonds or treasury bills. Now, treasury bonds are basically long-term securities, or we call them the debts. They are normally issued by the government, but for a longer period, like 30 years. And then we have treasury bills for a short-term period, which is 1 year and below. Can be 3 months, 6 months, and such like. Now, those documents that we're having, or those securities that we're having, they are normally attached on some money. So you'll be given a treasury bill account, then you go and invest and get money back. We say that those treasury bills and bonds are normally safe. They are traded, they are normally safe. But some cases, we have other investments that are not safe. For example, if you buy shares in companies, those shares can actually be risky. Those shares in other companies can be risky, though for treasury bills, they are considered to be safe. Now, because of the risk that is involved, especially when you're now trading majorly on those financial instruments are what we call derivatives. When you are trading on them, then it is exposing you to some financial risks. Now, we have derivatives. Derivatives are the same as those financial instruments. Their value are determined by the values of the money that is attached to them. We shall be able to define so that you get them well. But examples of derivatives I've talked about are the shares that you buy, the bonds, the treasury bills, and even the commodities, the physical commodities like maybe oil or other petroleum products. Those are called derivatives. So it means that the markets or the value of these instruments depends on the value of the derivative, the value of oil. So when you are buying them, if you buy some properties or you buy a commodity like oil, the prices in the markets will affect their value, right? So it means that if you are trading on such instruments, their prices will be affected by the prices of those commodities in the market, how they are affected in the market. But we shall be able to go through that. Let's define the term financial risk management first. I want you to say that financial risk management is a practice. Financial risk management is a practice. Financial risk management is a practice of protecting economic value. It is a practice of protecting economic value in a firm in order to manage exposure to financial risk. So it is just a practice of protecting your economic value in a firm. Practice of protecting economic value in a firm. This is a way of protecting economic value in a firm. Protecting economic value in a firm by managing exposure to financial risk. So you can proceed in the next paragraph and say that principally, operational risk, credit risk, operational risk, credit risk, and market risk. Operational risk, credit risk, and market risk, with more specific variants, are listed. So when we are talking about managing risk, we are managing risk like operational risk, we are managing credit risk, market risk, and other risks which have variants. So with more specific variants, those are the kind of risks that we are able to diversify or manage. Now, there are different ways, or we call them taujanja, of managing this risk. But we shall come there. I want you to define the term derivatives. I want to define the term derivative. So you say that the derivative is a type of financial contract, or it is an agreement that you get into. It is a financial contract whose value depends on the value of underlying assets. It is an arrangement or an agreement that you get into with somebody, and the value of that arrangement depends on the value of the assets which you are agreeing on, the assets that are in place, the assets that you are having a conversation on. And I give example of these derivatives. So you can have a contract in terms of the commodities that you want to trade. You can have a contract in terms of the shares that you're buying. The contract might relate to bonds or treasury bills. Now, those are what now we call derivatives. So derivative, the term derivative means the contract that you're going to have with somebody. So it is a contract whose value is dependent on, it is a contract whose value is dependent on an underlying assets. Whose value is dependent on underlying assets. You see, if we are buying, for example, a property, we are going to have an agreement where tunaandikiana. Or you buy land, you're going to be given a certificate. You buy shares, you're given a certificate. That certificate is the binding document. This is the contract. But that certificate, the value in it depends on what property you're buying. Is it property that relates to land? If it is land, then the value of that particular title deed depends on the value of land. Now, land is the underlying asset. Land is the underlying asset, but the certificate that you're having is now what we call a derivative, right? So it means that that certificate has got close relationship, and the value of that certificate, which is derivative, is affected by the changes or the variance in the value of land. So we are saying that these certificates or derivatives, they vary. There are others that we call over the counter, and then we have others that are traded in the market. So we have two. You can say that a derivative is set between two or more parties. A derivative is set. A derivative is set. And the word derivative, just write like this, derivative. So it is like a contract. It is set between two or more parties. It is set between two or more parties. It is set between two or more parties. An agreement between two or more parties that can trade on an exchange. That can trade on an exchange. When you're trading on an exchange, means that you are in the exchange market. Sasa, unaenda pale Nairobi Stock Exchange Market, then you trade there, mnaelewana huko. So, we are saying derivatives is between two or more people or parties that can trade on an exchange market. That can trade on an exchange market or over the counter. Then you put it in bracket OTC, or over the counter or OTC. Now, what do we mean by OTC? It means that mnaelewana na mtu kando, outside the market, right? Badala ya kwenda pale mweke vitu zenu kwa screen, you start trading and exchange on the screen, open where we have a control market. Mnafanya kando, over the counter, face to face, right? Instead of having it in the system. That is called over-the-counter. Now, there is a risk. When you decide to trade over-the-counter, it means that you're doing your business in like a black market. Over-the-counter is just an arrangement between you and the person umekutana na yeye huko nje. So, it is not an official market. The risk is that somebody might fail to pay. And so you are exposed because this person is not controlled. There is nothing like regulation that can demand that this person pays you. So the move to trade over the counter is more risky. And most people who are risk averse will not want to take that. They will prefer to go to the Nairobi Stock Exchange where things are traded and the market is protected. So it is not very good. But people do it. Those who are speculating can go. They rush and buy from you, then they go and sell it. It is quite risky. It is quite risky. I want to say that these counterparties, we say that there are 2 or more people can trade either in the market, exchange market, or over the counter. I want to say that these counterparties, these 2 parties, are subject to a pre-agreed set of terms. These counterparties, these for many, not this. These counterparties are subject to a pre-agreed set of terms and conditions. They normally agree on some terms and conditions because you are buying from somebody, he's also buying, he's selling to you. So mnaelewana. Sometimes you might buy not in cash, but you agree that let me have the property, I'll pay you after this period. Or you just agree in advance that you have a written agreement, mnaelewana, unasema, in the next 3 months, I'll come and buy from you at this amount or this rate. I don't have money now, but I'll come and buy from you in the next 3 days or 3 months. That is an agreement. That is an agreement. Sindio? Mnaweza elewana na mtu, mwambie bana, hii ng'ombe yako naona imenona iko sawa. Sina pesa sahihi, but I'll come and buy it from you after 3 months. I don't have the money now. But when I come in the next 3 months, please, what price can you sell it to me at? You agree that it will be 40,000. Now, after 3 months, it is a valid agreement. After 3 months, whether the prices have changed or not, the agreement that you had was a binding contract. So you don't change your mind. That could be the nature of agreement. You don't have to buy it cash. But alternatively, you can decide to buy it cash instead of waiting for 3 months because you don't know what the future holds. So you can decide to buy it now instead of waiting for 3 months because of the exchange rate in the market. And that's why we are now saying that it's a risk management. I want to buy something from you, but I'm feeling that the rates might change or even the prices might change in the next 3 months. So we have to agree now so that I can manage the risk that I could be exposed to in the next 3 months. Tunaelewana sahi kwa sababu siko sure after 3 months what will happen. So tunaelewana now. Why do we agree now and have a binding contract? I'm trying to reduce the risk that might occur because I don't know what the future holds. The seller also the same. Might also want to commit now because hayuko sure kama after 3 months from now, the prices can actually worsen. So we are saying that these 2 people, the parties who are in business, we call them counterparties. These counterparties are subject to a pre-agreed set of terms and conditions, and that is what I hope you've written, and conditions that determines their rights and obligations. That determines their rights and obligations. That determines their rights and obligation. So we are trying to run away from some risk. We are trying to run away from some risk. Let's now look at the kind of risk that we are trying to run away from. Let's look at the kind of risk that we are trying to run away from. Now, assuming that we are doing an agreement between you now from one country to another, that is international business, there are some risks that you can expose to. So we shall be able to look at this. So let's look at some of the foreign exchange rates that we can be exposed to. I want to call it foreign exchange rates. Foreign exchange rates. Because we are exchanging dollar and Kenya shillings. So there could be some risk that we are going to be exposed to. Foreign exchange risk. Foreign exchange risk stock exposure. The first one is called translation risk. See now when you're translating, I'm hoping that you have done this in accounting. You have done transaction in a foreign country and you want to translate so that you can consolidate. So we have financial statement, income, and balance sheet in US dollars and another one in Kenya shillings. We want to merge them together. So we have to translate these so that we have a one financial statement. You remember that in your group accounts translation? So I want to say that this refers to change of exchange rate. This refers to change of exchange rate between the date of transaction and the date of settlement. Between the date of transaction and the date of settlement. Between the date of transaction and the date of settlement. Stroke translation, presentation. Sorry, just say date of settlement, So there is a date that we agreed that we could be having our transaction, and then there is a date when I'll be paying. So I have to translate from one currency to another. Also, it could be possible that we are doing business and now my financial statement needs to be translated from one currency to another. But I want you to have it simple like that. It is a change of exchange rate between the date of transaction and the date of settlement. So settlement is the date when we are making the payment. Sorry, that should be transactional, not translation. That should be transactional. Transactional risk, transactional risk. That is the date of differences between the date of transaction and the date of settlement. Then number two, now we have translation date, translation risk. So this one, a change in exchange rates between transaction date and date of settlement. Then now we have translation date, translation risk. What I explained earlier, difference of financial statements of a foreign country. It is the difference of financial statements. It is the difference of financial statements. It is the difference of financial statements. The difference of financial statements of a foreign country the difference of financial statements of a foreign country when reported in a presentation currency. When reported in a presentation currency. Differences in financial statements of a foreign currency when reported in a presentation currency. When reported in a presentation currency. So you translate, and then the other one was transactional, where there are changes in transaction exchange rates. The other risk that we might want to avoid is called economic risk. Economic risk. Economic risk. It is a long-term movement in the exchange rate. It is a long-term movement in exchange rates. It is a long-term movement in exchange rates. Adversely affected. Sorry, you say that it is when, it is when long-term movement. It is when long-term movement. It is when long-term movement in the exchange rate. It is when long-term movement in exchange rate adversely affect the net worth. Adversely affect the net worth. Adversely affect the net worth. Adversely affect the net worth of a foreign entity. Adversely affect the net worth of a foreign entity. Adversely affect the net worth of a foreign entity. So we have seen three. We are basically saying that at some point, this one is economic risk. At some point, maybe economy of Uganda was doing very well and it was equivalent to Kenya. But then we reached a point where after long term, the net worth of citizens who are here or the country is not the same with that of Kenya. So if you are investing here, at that point you realize that when you go to Kenya, your investment would have been having a better value than if you remain in Uganda. The risk that comes with that difference, it is of a long period of time. I hope that you guys remember that at some point, 20 shillings was equivalent to 1 pound. At some point in this world or on earth. Kuna wakati mwingine hapa duniani currency yetu ya Kenya shillings, 20 Kenya shillings was equivalent to 1 pound, British pound. And that is why 20 bob is called pound. But after a long time, the economic value or economic worth of the Kenyan economy as a country has been affected. It went down. And so we lost the value. Today, as we speak, I don't know, maybe around 150 something. What is the value of pound against Kenyan shillings? And that is how we have lost over time. This one is called economic risk. Those who are invested in UK could be having a better value for their money than those who are investing in Kenya. It has taken a lot of time, a long period of time, for that to happen like that. And so that is why we are saying it is where the long-term movement in the exchange rates adversely affects the net worth of a foreign entity. It is a long-term risk, or this risk is long-term. Let's now look at the methods of hedging against this particular risk. To hedge is to escape or avoid. Unajaribu kuhepa. So there are two terms that we're going to have here. There is the term called arbitrage, and then there is hedging. Hedging is basically to prevent it or to reduce. But arbitrage means to take advantage of the situation. Arbitrage is to take advantage of the situation. Ukiona Kenya kuna waka, unaenda Uganda, unaenjoy huko. Ukisikia huko ni kuzuri, unarudi. Saa hii, Treasury bill has gone to 16.6%. People are now investing here. They are rushing to put their money here so that they can take advantage of the high interest rate at the expense of borrowers. When they are now investing here because they know they are going to get a lot, they are going to harvest. That is now called hedging, taking advantage of the situation. When people are crying or the situation is bad on one side, you take advantage on the other side. That is now arbitrage. But hedging is trying to escape. You are trying to reduce it or escape it by means, every means possible. You are not taking advantage. You are just unajaribu tu kuepa. So let's look at methods of hedging against exchange rates risk, or what we can call foreign exchange risk. In case you are doing business with somebody in a different country, and you feel like the business that you're doing with this person in a different country, you are exposed to some risk as a result of the foreign transactions. As a business person, you need to manage your finances. How do you manage this risk? So let's look at that. So methods, and we agreed, kindly make good notes. I want your notes. Zangu zimezeeka. My notes are now tired. They are old. So yours is still new. Can you make good notes after class? After exams? I'll come and pick them from you. Kindly. Have all your notes well written so that we can continue with the work. Hii ni kazi ya Mungu. Kufunza ni kazi ya Mungu. Method of hedging against foreign exchange rate. So that we can proceed with spreading the good news. Against foreign exchange risk. Foreign exchange risk. So foreign exchange risk, how can we avoid it? Number one, we have what is called non-contractual techniques. Non-contractual techniques, from the word contract, it means that we are not getting into contracts. Hey, we are not sitting down with you to agree on whether I will buy it after 1 year at this price or not. So there are techniques, there are methods that we can use to reduce risk as a result of doing business with somebody in a different country. But we don't have to have a written agreement. We also call it internal hedging. The second one is now called contractual techniques. Contractual techniques are called external hedging. External inamaanisha sasa tuna involve watu wa nje. We have to have a contract with the people. And so it's called external hedging. I hope that you are together up to there. So let's look at the first one, non-contractual hedging techniques. Let's start with non-contractual hedging techniques. Non-contractual hedging techniques. Non-contractual hedging techniques. So under non-contractual hedging techniques, that is number one. We have started with this. Which techniques are under this? Where we don't involve outsiders. Tunajipanga kinyumbani. As a business person, you just plan. The first one is invoicing in domestic currency. Invoicing in a domestic. I want you to say under this, I want you to say that it involves selling goods in Kenya shillings to all customers, both local and international. Not just Kenya shillings, but here we are considering Kenya shillings to be a foreign, the home currency. We are considering it to be home currency. So we are saying, tunakuwa mjanja wakati unafanya biashara. Na unajua vizuri, if I have to buy anything, I'm going to buy in a foreign currency. Or I'm going to sell in a local currency, then convert. Inanisumbua because I'm losing. So unaamua, mimi ni Kenyan, and anything that you want to buy from me, you have to buy in Kenya shillings. You see now, if you are paying Zoom, for example, today, or you are paying for ACCA, for those who are doing ACCA, you always pay in dollars. Why? They're using this. They invoice you in dollars. It is up to you to look for the money. Au wakishakwambia that it is $12, 12 USDs. That is it. They are invoicing you in their own currency, so that they don't have a problem of changing the amount that you're given them. Wewe ukilipa wanapata ikiwa in their own currency, story nation. They are trying to reduce this foreign exchange risk through invoicing. So if you are paying for Zoom, wanakwambia it is being paid in dollars. Everything in dollars. Foreign countries are doing that. Kuna hotel in Kenya, nimesikia, kuna some hotels in Kenya, when you go there, you pay in dollars. They are reducing that. Because if you were to pay in Kenya shillings, then they will have to convert it to dollars. Ndio watume huko kwao, if it is a branch of a foreign company or a firm. So we are saying that as a Kenyan, you can also decide to do the same. Tell them, anything that you're paying me, pay me in Kenyan shillings. I don't care whether it is Japanese yen, whether it is US dollars, whether it is maybe the pounds, British pounds, you know, whether it is Indian rupees, I don't care. So I just have it in my currency. That one will reduce your stress of translation. Number two, so we are saying that sell goods and services in the local currency to both local and international customers. Sell in your local currency to both local and international customers. Number two, another method that you can use to avoid this challenge. Is somebody talking? Pista, you have a question ama umeji unmute na ujui. Number two, We call it leading and lagging. Lag is remain behind, still. Somebody is lagging behind. Amebaki nyuma. And leading, of course, being ahead. So that is another method, leading and lagging. We are saying that this involves paying overseas suppliers earlier, paying overseas suppliers earlier, in bracket leading, paying overseas suppliers earlier, in bracket leading, when the currency is falling, and paying them later, that is when the currency is falling, when the local currency is falling, and paying them later, when the domestic or local currency is expected to rise. When the domestic or local currency is expected to rise. Si hiyo ni ujanja? Saa zingine unaamua unachelewa kidogo, saa zingine unaamua unalipa mapema, depending on what the ground is saying. You listen to the ground, right? So how does this work? Let's say that I'm supposed to pay my goods worth Kenya shillings. You know, I bought some goods from outside, and I've been told that I need to pay maybe $150. These are the goods that I bought. At the time I bought them, so they have supplied me. At the time I bought them, maybe the dollar against Kenya shillings was 100 Kenya shillings against $1. So if I pay now when the rate is this, I'm going to pay a total of how much Kenya shillings? I'm going to use this kind of Kenya shillings. 125,000 Kenya shillings. Now, we are saying that you can decide to do what? To pay early. If you know, you can decide to pay early if you know that the prices will be falling soon. You can decide to pay early if you know that the prices are falling soon. So if this price falls, what will happen? Is it going to be 120, or let me say 110, or it is going to be 90? Tell me, if the value of our currency falls, is it going to be 110 or 19 or 90? Mtu aniambie. Because we are saying, tipping and lending says that you pay overseas suppliers, those international suppliers, early when you expect the currency to fall. So our currency is Kenya shillings. We need to pay them. We have agreed in dollars. We need to pay them in dollars. This is the current state. Now, between 110 and 90, which one represents a fall in our currency? The Kenya shillings. How I wish that everybody would participate, because this thing you need to understand it. My good people, you have to understand this thing, otherwise itakushika. Hii topic lazima ikuje kwa mtihani. The best thing you can do for me is to participate so that we move together. Hii topic number 6, lazima Sasa utakuwa unashangaa what is happening. And in this class I have more than 2 people. That one I'm very sure of. Tumeamua aje? Mary, Lea. Tumeamua aje? Hapana kuongea. Hapa lazima tu participate. I'll be asking so many questions. Lazima. Henry. Which one shows that there is a fall in our currency? $110. Thank you. So we are saying that we need to pay early. We need to pay as soon as even today so that we can pay this. Because if there is a fall, we are going to pay this. And that means that we're going to pay more Kenyan shillings. That is 150 times 110. That is equivalent to how much? Instead of 125,000, we're going to pay how much? $137,500. So we are going to lose. Tukingoja tu kidogo, we are going to lose. So it is better we pay today, this one. We pay early instead of waiting to pay later. But if we know that our Kenyan shillings is strengthening, is becoming stronger, then we can wait and pay at 90 when it is now 90. So we pay 125.0 times 90. That gives you how much? This looks like 45. So we have 50. This is 4, then this one is 2. This one has this 1 plus 2. Is it that? So we pay 112 instead of 125. I'm not very accurate. I'm using my medulla oblongata. So let me see. To me, it is correct. It is very correct. So that is what we mean. And that's why we are saying that if you know that your currency is going to strengthen in the future, unangoja kidogo, alafu sasa unalipa hii instead of paying this one. Let's come to the next one, matching. Matching. Thank you, Adrian. So matching, that is number 3. Matching. This entails using foreign currency loans, right, like that. This entails using foreign currency loans. This entails using foreign currency loans to finance overseas entities or to pay overseas entities. This involves using foreign currency loans. It involves using foreign currency loans to pay overseas entities. And using overseas earnings to pay overseas loans. And using overseas earnings to pay overseas loans. And using overseas earnings to pay overseas loans. So what are we saying? And this one is very important. You're going to use it somewhere in money. You're going to use it somewhere in money market. and forward market. So you need to understand how this happens. So what happens? You are in US or you are in Kenya. You are in Kenya and you are doing business with somebody in US. So you need to make some payments here. Instead of taking Kenya shillings to convert, you take Kenya shillings here, convert it to US dollars and pay. That conversion is what we don't want, because you are going to lose some money when you are converting. You need to make payment in US, fine. You are in Kenya, you need to make payment in US dollars. You have been supplied with something. So instead of using Kenya shillings, you convert it and pay. You are going to use US dollars. So that is what we are saying. That use foreign currency loans to finance overseas entities or make overseas payments. You come to here, borrow loan in US dollars, use that amount to pay here. Kuja uchukue loan hapa na ulipe hizo madeni. Make those payments. So you are not going to cross any currency or using overseas earnings to pay overseas loans. So wakati sasa the loan will be due for payment. You have taken the money here, loans, to finance your business. You run the business. When you get the profit in US dollars, take that profit and pay loans in dollars. You have nothing to do with the Kenya shillings. You want to start a business in US, go and take loan, do business there, or make payments for that business that you're doing there, make all the payments. Wakati utapata profit there, use that profit to pay the loan, because you're going to get the profit in US dollars. So you don't cross any currency. You don't exchange any currency. Number 4 is called netting. Netting involves offsetting foreign debtors and foreign creditors. Offsetting foreign debtors and foreign creditors. So how do you offset foreign debtors and foreign creditors? It is almost the same as this. Netting, you net off. Kama mtu alikuwa na pesa yako hapa, anafaa kulipe in 3 months time, maybe like 120 US dollars. Akikulipa tu hivi, chukua hiyo pesa ulipe zile madeni uko nayo in dollars. You also owe somebody that you're supposed to pay in 3 months. You need to pay somebody in 3 months, maybe $100. So wait, this guy akikulipa tu hivi, chukua hiyo pesa ulipe deni hapa. You are netting off, zero effect. You are not coming home with any amount. So take the debts, clear the arrears, clear the creditors. Use debtors to clear creditors. Or we are saying that it is about offsetting foreign debtors and foreign creditors, or purchasing in foreign countries. Purchasing in foreign countries. Purchasing in foreign countries where sales have been made. Purchasing in foreign countries or country where sales have been made, so that foreign currency receivable. Purchase in foreign countries where sales have been made, so that foreign currency receivables offset foreign currency payable. Foreign currency receivable offsets foreign currency payable, hence reducing the amount exposed to foreign risk. Hence reducing the amounts exposed to foreign risk. Tuko sawa hapo? So if you are doing business, you are in Kenya, but you're doing some business in US, and you have made some sales in US dollars like 100. Now go and buy something in US. Go and buy something in US of even equivalent amount. Take your sales, make the payments, so that you don't exchange any money. There is no physical exchange of money, or no exchange at all. So you need to go and purchase in the foreign current country where you have made some sales, because you made sales in that current country's currency. Tumia hiyo pesa yao, nunua hizo vitu unataka kununua, alafu rudi nyumbani na commodity or properties. So you only come with the property or commodity that you have purchased. So we are saying that or purchase in foreign currency, foreign country where sales have been made, so that foreign currency receivable offsets foreign currency payable. Offsets foreign currency payable. Therefore, reducing the amount exposed to foreign risk. Reducing the amount exposed to foreign risk. I want you to look at the last one, which is management barriers. That is the last one. It's called management barriers. Management barriers. This involves restricting or reducing remittance from subsidiaries. You know, you have subsidiary in US. Instead of them remitting money when they make any sales or profit, unawaambia kaeni na pesa yenu huko, mjipange. So it is about reducing remittance from subsidiaries. Reducing remittance from subsidiaries. So are we okay up to there? Those methods that have been asked. Methods that you can be able to use. Tuko sawa kwa hizo zote, si ndio? I'm just trying to check if they have ever asked that kind of question before. So those are internal methods or non-contractual methods of hedging against foreign exchange risk. I want us now to look at contractual methods. Contractual methods. So contractual hedging or methods, contractual hedging techniques or methods. Number one is called forward market hedging or contract. Forward market hedging or forward contract. So these are contractual techniques. So the first one is forward contract, or you can also call it forward market. Hedge. It's a way of hedging where you have a forward contract. You agree with somebody, so mnaandikiana sahi, lakini you'll be able to transact in the future. You agree now. The second one is called money market hedge. Or contract. They can use the word contract or market hedge. Money market and forward contract. The third one is called future contracts or future market hedge. Future contracts or future market hedge. Number 4 is called currency options or options market hedge. Currency options or option market hedge. Option market hedge. The next one is called currency swap.
Nachapa tindo. Chapa recho.
Currency swap. Currency swap. Mbona mnacheka? Currency swap. So let's talk about the first one. We define it. And you start with the forward contract. Say that these are legally binding agreements. These are legally binding agreements. These are legally binding agreements. These are legally binding agreements to buy or to sell. To buy or to sell. It is a legally binding agreement to buy or to sell. That is forward contract. To buy or to sell buy or to sell a specified quantity, to buy or to sell a specified quantity of a specified currency. To buy or to sell a specified quantity of a specified currency at a future date. At a future date at a predetermined exchange rate. So you agree, it is a legally and binding agreement where you agree to buy or to sell a specified currency, a specified currency a specified currency at a future date and at a predetermined price. So mnaelewana that you'll be able to buy US dollars in the next 3 months, and you have to specify the date and you agree on the exchange rate in advance. The terms are agreed. The terms are agreed in the present time. Any mna agree sahi. It is an agreement for buying or selling to a specified date on terms agreed in the present. The terms are agreed in the present. I want us now to look at the swaps. Swaps. We say that not swaps, sorry, future contracts. We have forward and future. So we have defined forward, now future, sorry. Future contracts. You can say a future contract is an agreement of buying a future contract is an agreement of buying, stroke selling. It is an agreement of buying or selling fixed or standardized unit. Fixed or standardized unit. It is an agreement of buying fixed or standardized unit of a given rate or price. Of a given rate or price on a specified future date. on a specified future date. So it is an agreement of buying or selling fixed or standardized unit. Are you seeing the difference? The other one was just buying or selling. There is nothing fixed or standardized. This one is fixed and standardized. The forward, it is not fixed unit. It is just a given, any, not fixed or standardized. Look at the two differences. One is forward, another is future. For future, is fixed or standardized unit of a given rate stroke price on specified future date. On specified future date. I want us to look at the differences between future and forward contracts. Differences between future and forward contracts. So we can have future here. And we have forward here. Future and forward contracts. The first difference between the two, future is quoted in USD, while forward is quoted in any currency. Quoted in USD, quoted in any currency. That is the first one. Number two, traded in a formal market. The other one is traded over the counter. It is tailor-made. Traded over the counter, it is tailor-made. Regulated by future trade authority. Regulated by future trading authority. Or commission. Self-regulated. Self-regulated. Self-regulated or self-regulating, just say self-regulating. Whenever you see something being traded over the counter, I said that it is risky because nobody controls what you're doing. Mnaelewana tu? The next one, the party is required to deposit some money referred to as margin. Inamaanisha kwa hii future is very strict. Kama mnaelewana lazima uweke kapesa kidogo, wanashika as a form of a binding agreement to show that you are committed. It is a form of commitment. So the parties require to deposit some money, which refers to as margin. In this other one, no money is required. No money is required to be deposited. No money is required to be deposited. Or we say no margin is required. No margin is required. The next one, it is standardized, or it has standardized or fixed unit. Has standardized so fixed unit. No fixed unit. No fixed unit. No fixed unit. No fixed unit. Because of regulation, which I said, we are saying that this one is less risky. They are less risky. They are less risky since they are regulated. Since they are regulated. High risk since they are self-regulated. They are self-regulated, so high risk. High risk because they are self-regulated. High risk because they are self-regulated. They are self-regulated, so it is high risk. We shall look at the next one that is called swaps. 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 Then you say that a swap is a financial arrangement. 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 A swap is a financial arrangement between parties to exchange certain benefits. Financial arrangement between parties to exchange certain benefits, stroke assets and liabilities for their mutual benefits. A swap is a financial arrangement between parties. Financial arrangement between parties to exchange certain benefits, assets and liabilities for their mutual benefits. So it is an arrangement to exchange certain benefits like assets or liabilities for mutual benefits. You see, even liabilities must exchange. Do you know that? If you have loan, you can exchange with another loan. That is swap. So let's look at the types of swaps. Types of swaps. The first one is called interest rate swap. We also call it plain vanilla. Plain vanilla. Plain vanilla. Plain vanilla. That is the first one. The second one is called currency swap. The third one is called commodity swap. See, sasa hii ni exchange of goods. We have equity swap. You exchange shares. You swap shares. Number 5, credit rating default swap. Credit rating default swap. I want us to focus on the first two. Let's focus on the first two. Call it interest rate swap or plain vanilla swap. Interest rate swap or plain vanilla swap. And say that this occurs where investors can borrow Interest rate swap occurs where investors can borrow the same currency at different interest rates. You can borrow the same currency at different interest rates. It entails investors borrowing on behalf of each other in order to minimize interest expense. And I want to give you an example. Unajua unaweza enda, for example, an example tu, unaweza enda kwa duka ya Muhindi. Unaitisha loan, unaomba loan kwa banki ya Muhindi. Unaambiwa the current loan we can only give you, because wewe ni black, kwa sababu wewe ni black, we can give you at 20%. You are high risk. Lakini Muhindi mwenzake akienda anamwambia we can give you at 14%. You see the KBR rate is 8. KBR rate is 8.5, right? That is the base rate. So, as long as they are above this, they can even give their fellow Muhindi at 10. Lakini wewe wanakupea at this. So, what do? Unamwambia, enda pale, ongea nao Indian wenzako, wakupee loan at this rate. What you are trying to do, una exchange, anakupea loan at this rate. Akishakupea, wewe ndio unalipa sasa, the black man, wewe ndio unalipa hiyo. So mwana swap, because the same amount you can be given but at different rates. So yeye anachukua, anakupea, wewe pia unaweza chukua mahali, nampea, exchanging. That is what we are saying when we say, or what we mean when we say, that this occurs where investors can borrow the same currency at different rates. It entails investors borrowing on behalf of each other in order to minimize the interest expense. Proceed and say that often, interest rates swap will involve exchange of a fixed rate loan. Often, interest rates swap will involve exchange of a foreign rate loan. It involves exchange of a foreign rate loan with a floating rate loan. With a floating rate loan. With a floating rate loan. Some entities may have comparative advantage in the fixed rate market. Some entities may have comparative advantage in the fixed rate market, while others have comparative advantage in a floating rate market. Some entities might have advantage in the fixed rate market. Some entities might have advantage in the fixed rate market, while others have comparative advantage in a floating rate market. 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 Example. Example. Firm A, example. Firm A will request Firm B to borrow Kenya shillings 1 million at 14%. Firm A will ask or will request Firm B. Firm A will request Firm B to borrow Kenya shillings 1 billion at 14% in the fixed market, at 14% in the fixed market, Farm A will request Farm B to borrow Kenya shillings 1 million at 14%, sorry, at 14% in the fixed market, while it will borrow the same amount on behalf of Farm B, in the floating rate market, at an interest rate equal to the base lending rate plus 0.5. While it will borrow the same amount on behalf of Farm B in the floating rate market, at an interest rate equal to the base lending rate, plus 0.5%. So if the base lending rate is 8%, they can borrow at 8.5 at the floating. The second paragraph. At the end of the year, Farm A will pay Farm B. At the end of the year, Farm A will pay Farm B interest rate expense, i.e., at the end of the year, Farm A will pay Farm B interest rate expense, i.e., 14% of 1 million, which is equal to 140. B will borrow on his behalf. Unaelewa? A can request B to go and borrow on his behalf 1 million. So if B borrows, the problem is that B will be paying a higher interest. So to compensate that, A will accept to pay that particular interest. So that's what we are saying. At the end of the year, Farm A will pay Farm B interest expense, i.e. 14% of 1 million. Another paragraph, Farm B will pay Farm A. Farm B will pay Farm A. Farm B will pay Farm A interest expense equal to base lending rate only. Farm B will pay Farm A. Farm B will pay Farm A interest equal to base lending rate only. And thus, Farm A will have increased extra expense. And thus, Farm A will have incurred, and thus Farm A will have incurred extra expense to the fluctuating loan, which is not refunded by B. And thus, Farm A will have incurred extra expense to the fluctuating loan, which is not refunded by B, amounting to 0.5% times 1M. 0.5 times 1M, it is 500. Anyhow, those are just an illustration theory. Let's look at the last part and then maybe we can stop there. I want us now to look at the other swap, which is called currency swap. Currency swap. So I want to say that a currency swap is a financial contract between two parties. It is a financial contract between two parties to exchange a specific amount of currency. It is a financial contract between two parties to exchange a specific amount of one currency for an equivalent amount of another currency. Currency swap is a financial contract between two parties to exchange a specific amount of one currency, for an equivalent amount of another currency. The purpose of currency swap is to reduce currency risk. The purpose of currency swap is to reduce currency risk. The purpose of currency swap is to reduce currency risk. The purpose of currency swap is to reduce currency risk. The purpose of currency swap is to reduce currency risk, comma, achieve lower financing cost, achieve lower financing costs, achieve lower financing costs, or gain access to a foreign currency, or gain access to foreign currency, or gain access to foreign currency. The purpose of currency swap is to reduce currency risk, comma, achieve lower finance cost, or gain access to a foreign currency, or gain access to a foreign currency. Now we have two areas that we shall cover in our next class. This forward contract ni hesabu. So whatever we have done is just the beginning. We shall define option. We shall define option. And then we look at the types of options that are there. So let's start from defining options. So you'll remind me. So we have done option. We shall look at options, definition, and then we define money market, or we can start with the money market and then option. So we shall start with either of them. Money market, then option, or start with option, then money market. Either is okay. Then we shall do some calculation then. Or do we need to define option before we move? we close the meeting. What do you guys think? Just define it. Ama tufanye next time. Yeah, we shall start from money market side to mechoka. So let's start from money market. Then we shall look at options and the types of options that are available. Option is basically just an option like the way we are saying. You have an option to go home. You have an option to attend class or to go for outing. So that will be the end of today's class. Let's proceed. Thank you so much. Have a good night. Next time. Good night.